Have you ever wondered about VPF, or perhaps pondered whether this might be a viable investment option for you? Let's unravel this financial term together. VPF, standing for Voluntary Provident Fund, is also known as the Voluntary Retirement Fund. This fund is essentially a tool for employees to build a substantial retirement corpus, backed by the Indian government. Offering interest rates that are nearly risk-free and often higher than most safe investment options, VPF is a voluntary scheme wherein employees can make substantial contributions. However, it's crucial to remember that an employee's contribution to VPF must exceed their EPF contribution to maintain a VPF account. In fact, an employee can contribute up to 100% of their basic pay and bonus to VPF, but the employer won't match this contribution. Now, let's delve into the key characteristics of the Voluntary Provident Fund. Firstly, it's important to understand that VPF accounts are linked to the Employee Provident Fund, so salaried professionals don't need separate VPF accounts. The VPF investment automatically gets credited to their EPF account. Any salaried professional can deposit up to 100% of their basic salary and dearness allowance into their VPF account. However, the VPF scheme is not available to self-employed professionals, non-professionals, or those employed in unorganized industries. The salaried professional must be employed by an organization registered with and approved by the Employees Provident Fund organization to be eligible for VPF benefits. One of the notable elements of VPF is the flexibility it offers. The amount invested can be any amount, minimum or maximum, but employees can't contribute more than 100% of their basic pay and DA. Moving on to withdrawals, it's worth noting that withdrawals from VPF accounts cannot be made prior to 5 years from the first investment date. However, VPF has a much shorter maturity period than PPF, which is 15 years. One of the advantages of a VPF account is that it allows investors to withdraw all or part of their investment balance. However, it's advisable to be aware of the tax implications before doing so. If an investor retires or resigns from their job, they will receive their entire VPF maturity amount. Now, let's highlight some of the top benefits of VPF. Firstly, VPF is a low-risk investment, as it is managed by the Employees Provident Fund organization under the central government's Ministry of Labour and Employment, meaning there is no investment risk. Secondly, VPF allows either full or partial withdrawals 5 years after the account opening date. Thirdly, an investor can deduct up to INR 150,000 from their taxes under Section 80C of the Income Tax Act, which can save them up to INR 46,800 in annual taxes under the old regime. Furthermore, an investor's accumulated funds in a VPF account are tax-exempt if the interest rate exceeds 8.5%. VPF also offers a higher interest rate compared to other deposit plans with a sovereign guarantee like PPF, SCSS, MIS, PMVVE, etc. When an investor decides to retire or resign, they can withdraw from their VPF. This makes VPF more liquid than life insurance plans or PPF. Finally, the application process for VPF accounts is straightforward for salaried professionals. So to sum up, VPF is a voluntary government-backed retirement fund that offers a range of benefits, including low risk, tax deductions, high interest rates, and flexibility in contributions and withdrawals. However, it's important to remember that it's only available to salaried professionals working for an organization registered with the Employees Provident Fund organization.